Iron Financial. Our mission here is simple: to help you forge a stronger portfolio by cutting right through the market noise to get to the hard truth. Today, we are putting the German software titan SAP under the microscope. Now, on the surface, the company just posted what looks like a blockbuster year, but the market, well, it reacted with absolute brutal force. We're here to find out if this thing is a solid foundation or just a house of cards. Yeah, exactly. And look, this isn't just some academic exercise. This is a blue chip company, right? It's a core holding in countless portfolios. So when it makes a move like this, we have to ask the tough question: is SAP a fortress built on solid fundamentals, or is it a polished facade with some really dangerous cracks starting to show? Let's dive in.
So this is the number that just completely rocked the market. On January 29, 2026, SAP's stock didn't just dip, it absolutely plummeted, nearly 15% in a single session. And to put that into perspective for you, this was its worst single-day drop since the dark days of October 2020. I mean, a brutal, punishing reaction from investors that wiped out nearly 2 years of gains in just a matter of hours. This was not a minor correction. This was a full-blown panic. A move this violent? Well, it demands an explanation.
And that's the absolute core of the conflict we're digging into today, right? You've got a company posting strong cloud growth, record backlogs, and they're showering investors with buybacks. But Wall Street treats it like a pariah. It just makes no sense on the surface. And this is the kind of paradox that can signal one of two things. Either it's a massive buying opportunity for people who have the stomach for it, or it's a giant red flag, a hidden structural flaw that the smart money has already sniffed out. So what is it? Is this just a classic market overreaction, or are the cracks in this foundation just too deep to ignore? We're about to find out. Okay, so here's our game plan for today. First up, we'll set the scene and really analyze the market's brutal reaction in A Titan Takes a Tumble. Then I'm going to build the fortress of fundamentals, laying out the bull case for you brick by brick. After that, I'm grabbing my magnifying glass, and we're going to search for the bearish cracks, focusing on that one metric that seems to have caused all this chaos. Next, we'll examine the potential game changer, SAP's AI growth engine. And finally, we'll deliver our final verdict, weighing all the evidence to see if this is a solid investment or a trap. All right, let's get to work.
So let's lay the groundwork for this incredible market drama. The date is January 29, 2026. SAP releases its full year 2025 earnings report before the market opens. And the headlines, they're glowing. Revenue targets met, profits exceeded, cash flow is soaring. By all accounts, it really should have been a victory lap for the CEO, Christian Klein, and his team. But, that's not what happened. The market opened, and the bottom just fell out.
And that's the crucial point right there. The market is a forward-looking machine. It doesn't just react to what happened last year. It's completely obsessed with what's going to happen next year. And something in that report, buried deep beneath all the positive headlines, it sent a shockwave of fear right through the investment community. Sophisticated investors, hedge funds, institutional players, they don't just dump a blue-chip stock by 15% on a whim. No way. They saw something that spooked them, a single data point that called the entire growth story into question. So our job is to figure out exactly what they saw and whether their fear is actually justified.
All right, before we get to all the fear and panic, it is critical to understand the foundation here. To really see why this sell-off was so shocking, we have to build the bull case. And let me tell you, based on the full-year numbers, it's a pretty compelling one. We are talking about a financial fortress. If you were just looking at the headline metrics for 2025, you'd think this stock should be soaring, not collapsing. So, let's get into the hard data.
Now, what's really interesting about this is the sheer power of their core business transformation. Just look at these numbers. Cloud revenue is up a massive 26%. And this isn't some side project. This is the absolute heart of SAP's future strategy. To put that 26% cloud growth in perspective, it's outpacing some of their big legacy rivals like Oracle in key segments, and it shows they can definitely compete in the same arena as the hyperscalers. But what's even more impressive is the Cloud ERP Suite revenue, growing at an incredible 32%. This is their flagship S/4HANA offering, the engine that's driving their transition away from those old-school software licenses. These aren't just good numbers, they're market-beating numbers that prove the core engine is firing on all cylinders. This number right here, this is the bedrock of the bull case, 77 billion euros. That is SAP's total cloud backlog, and it's up a staggering 30% year over year. So think of this as guaranteed future revenue. It's the sum of all the contracts they've already signed for cloud services that will be recognized as revenue in the coming years. A backlog this huge and growing this fast provides an incredible level of predictability and visibility.
It's like a fortress wall of revenue that protects the company from short-term economic turbulence. It tells us that the demand for their solutions isn't just strong today, it's locked in for years to come.
Okay, so if the backlog is the fortress wall, then free cash flow is the war chest inside. And let me tell you, SAP's chest is absolutely overflowing. They generated 8.24 billion euros in free cash flow in 2025. That is a 95% increase, almost double the previous year. This is exactly what you want to see in a mature tech giant. It's not just about revenue growth, it's about profitable, cash-generating growth. This incredible cash generation gives them immense financial flexibility to invest in R&D, make strategic acquisitions, and, as we're about to see, return massive value to their shareholders. This is not a company that's struggling for cash. It is a cash-printing machine.
And this just brilliantly illustrates what a company with a massive war chest does. They announced a new 10 billion euro share buyback program. This is a colossal vote of confidence from the board of directors and the management team. A company doesn't authorize a buyback of this magnitude unless they believe two things. One, that their business is fundamentally strong and will keep generating huge amounts of cash, and two, that their stock is undervalued by the market. It's a direct signal to investors that basically says, hey, we believe in our future, and we think the current stock price is a bargain.
So here's the crucial point. You have the CEO, Christian Klein, taking a victory lap. And why shouldn't he? Record backlog, surging cloud revenue, doubling the free cash flow, and a massive buyback. From a long-term, fundamental perspective, the structure of this company looks incredibly solid. The bull case is simple and it's powerful. SAP is successfully navigating its cloud transition, its financial health is outstanding, and management is clearly confident. Based on this evidence alone, that 15% drop makes absolutely no sense.
Okay, that's a nice story. A strong fortress, a confident CEO. It sounds great, but it doesn't explain the bloodbath on January 29th. The market saw something else. It looked right past the strong walls of the fortress, and it found a crack. And that crack was just big enough to make everyone question the entire structure. So, it's time to stop admiring the architecture and start looking for the flaws. It's time to find out why the market panicked.
And here it is, the source of all the anxiety. On this slide, you can see the tale of two backlogs. On the left, you've got the number the bulls absolutely love, that massive 77 billion euro total cloud backlog, growing at a healthy 30%. But on the right, we have its less impressive sibling, the current cloud backlog, or CCB. It grew by only 25%. Now, it might not seem like a huge difference, but in the world of high-stakes enterprise software, that 5-point gap is a chasm. The market fixated on this single discrepancy, and it's right here where the bullish narrative starts to crumble.
So let's be really precise about what this CCB actually is, because it's the key to this whole story. The total cloud backlog is the long-term promise of revenue over many years. But the current cloud backlog, that's the promise for right now. It's the revenue from existing contracts that SAP expects to hit the books within the next 12 months. Wall Street watches this number like a hawk because it is the single best indicator of near-term growth momentum. Is growth accelerating or decelerating? The CCB holds the answer. A strong CCB means the next year looks great. A weak CCB, well, that's when the alarm bells start ringing.
And this is the nail in the coffin. This wasn't just a miss, it was a completely self-inflicted wound. As Jefferies analyst Charles Brennan points out, SAP had basically pre-warned the market. They had guided for 26% growth, and they even suggested that 25% would be a disappointing outcome. And then what did they do? They delivered exactly that, a disappointing 25%. It's a cardinal sin in the eyes of investors. You just don't set expectations and then fail to meet them. This wasn't just a number, it was a breach of trust. It validated every single fear that the company's near-term growth was slowing down.
Okay, so let's look at management's side of the story. On the earnings call, they offered up a few key reasons for this. First, they claimed they signed a higher number of massive, long-term transformation deals. Now, these are great for the total backlog, but the revenue ramps up really slowly, so less of it hits the books in the first 12 months, and that hurts the CCB. Second, they pointed to more government contracts, which often have these termination for convenience clauses that, by accounting rules, can't be included in the CCB. And finally, they blamed geopolitics. Rising tensions are pushing more clients toward complex, sovereign cloud solutions that just take much longer to negotiate and deploy. So in short, their argument is that the revenue isn't lost, it's just delayed, pushed from 2026 out into 2027 and beyond.
But are those real reasons, or are they just convenient excuses? That's the billion-dollar question, isn't it? The bull case says, hey, this is just a temporary timing issue. But the bear case suggests it could be a mask for a much more fundamental problem. While everyone was focused on the backlog, something else was happening. Traditional software license revenue cratered by 27%. This is the legacy business they're trying to transition away from. So if that business is collapsing faster than the new cloud business is ramping up to replace it in the short term, you've got a serious problem. The CCB miss might not be a blip. It could be the first warning sign of a difficult and weakening transition. And the market? Well, it chose to believe the latter.
All right, so the market is stuck in the mud, completely obsessing over the CCV miss and a potential slowdown in 2026. But while they're all looking in the rearview mirror, SAP is trying to point everyone's attention to the road ahead. They argue that the real story, the engine that's going to power future growth and re-accelerate the business, is business AI. And this is where every investor needs to be really careful. Is this just the latest tech buzzword, a desperate attempt to change the narrative away from a bad metric? Or is SAP's AI offering a genuine heavy lifter that can actually carry the company forward? Let's see the evidence.
Now, this is where it gets really interesting. SAP is putting hard data behind their AI claims. Just look at this donut chart. It shows that in the fourth quarter, a massive 2/3 of their cloud order entry included their business AI offerings. This isn't a footnote, it's a primary driver of new deals. And this suggests that AI isn't some far-off promise for SAP. It's not a lab experiment, it is a commercial product that customers are actively buying and embedding into their contracts right now. This is tangible evidence that their AI strategy has real commercial traction.
And who are these customers? We're not talking about small startups here. We are talking about global blue-chip titans, Siemens, Bosch, L'Oreal, H&M, Lockheed Martin, even the US Navy. And that is a powerful list. I mean, these are some of the most sophisticated and demanding organizations in the world. When a list of clients like this signs on for your new AI platform, that is a powerful validation. It proves that SAP's AI isn't just a marketing slogan. It's a serious enterprise-grade solution that's gaining adoption across a ton of industries, from manufacturing and retail all the way to defense. So the crucial question is, what does this AI actually do? This slide gives us a perfect, concrete example. At Siemens, they are using SAP's AI Copilot, which is named Joule. And the result? Their consultants can now reinvest a quarter of their work week into higher-value tasks. This is the holy grail for enterprise software. It's not about fancy features, it's about delivering a measurable return on investment. A 25% productivity gain is a massive number that gets the attention of any CFO. It proves that SAP's AI isn't just hype, it's a tool that drives real efficiency and solves real business problems. And that is what companies pay for. Okay, we've laid out all the evidence. We've built the bull's fortress of fundamentals, and we've exposed the bear's cracks in the foundation. We've also examined the potential game changer in their AI engine. Now it's time to step back, weigh the short-term market panic against the long-term structural integrity of the business, and deliver the iron financial verdict.
Let's just summarize the entire debate right here. In the foundation column, the bull case is built on solid rock. You've got the massive 77 billion euro total backlog providing that long-term visibility. You have the gusher of free cash flow, nearly doubling to over 8 billion euros. You have clear, tangible AI adoption with 2/3 of new deals including it. And you have management's confidence, backed by a 10 billion euro share buyback. But then we have the flaws. The bear case is undeniable. The CCB miss at 25% was a self-inflicted wound that completely shattered near-term confidence. The resulting 2026 guidance implied a further slowdown. The steep 27% software license decline raises serious questions about the speed of their transition, and all of this has created an overwhelmingly negative market sentiment. The battle here is really between long-term strength and near-term fear.
So what's our final verdict? At Iron Financial, we believe the market's reaction, while understandable, was an overreaction. The CCB miss is a legitimate concern and, frankly, a major communication failure by management. It creates genuine near-term weakness and absolutely justifies caution. Yeah, and let's be crystal clear about this. The stock is likely to be dead money for a few quarters until they can prove the backlog issues are truly temporary and deliver a clean quarter that rebuilds trust. But you cannot ignore the sheer financial power of this company. The fortress is real. A 77 billion euro backlog, 8.2 billion in free cash flow, and a dominant position in the enterprise market provide a massive margin of safety. And more importantly, the rapid adoption of their business AI is not hype. It is a powerful new growth engine that the market is currently ignoring. So, is this an opportunity? For a short-term trader, absolutely not. The sentiment is terrible. But for a long-term investor with a strong constitution, one who can withstand the near-term volatility, this brutal sell-off has likely created a compelling entry point into a high-quality, cash-generating titan that is a leader in the next wave of enterprise AI.
The final question you have to ask yourself is this: do you invest based on last quarter's fear or next decade's foundation?